Chapter 3 focuses on liabilities, and it's the first of two chapters that we'll see that covers liabilities. So let's start with the basics before we really get started in any of the homework. What are the characteristics of a liability? Well, the FASB has actually gone in and defined what a liability is. So if you go into your textbook, you're going to see this definition. And by the way, we have seen this definition in Chapter 2 of the book on the conceptual framework. We saw it again in Chapter 5 on the balance sheet, and we're seeing it again here in Chapter 13. So we've seen it consistently throughout. So if you haven't mastered it by now, now's the time to do that. Well, a liability, as the FASB defines it, is a future sacrifice of economic benefits. So, and it also has the word probably. So it's likely we're going to have to sacrifice something. So let's look at this phrase here, economic benefits. What does that mean? What is an economic benefit? So if you stop and think about it, generally those are assets. Well, assets are actually economic resources, but they're a benefit. So assets are economic benefits, or it might be that we provide goods and services. So, we're either going to give up an asset or we're going to give up some of our goods or our services. So we're probably going to sacrifice those in the future. So in the future, we're going to give up assets in general. Well, why are we giving those up? Because it is a result of something that's already happened in the past. So we've already had a past transaction or an accounting event occur, and because of that accounting event, in the future, we will give up assets or goods and services to relinquish whatever debt that we owe. So in other words, let's look at the big picture here. So in other words, a liability is an obligation to transfer some type of resource in the future as a result of a past transaction. So that's a really good definition here of just shortcutting it. So in each one of those words is very significant. And so we're going to see as we work through the homework that we really have to have a clear understanding of this to decide is this a liability or not. Okay, let's move on to the next item. How do we distinguish a current liability from a long-term liability? Well, if you think about it, and if you go back to your textbook, same page that this definition was on, current liabilities, up to this point, we have distinguished them from long-term based on time. So time is a factor. So time meaning, less than a year or one operating cycle. So let's look at that definition. So current liabilities are obligations expected to require the use of existing resources properly classified as current assets or current liabilities. So time is a factor. So generally, let's go down here, finish this out. Generally, payables or current liabilities are due within 1 year or the operating cycle, whichever is longer. And so, most times a current liability, the cutoff point is 1 year. But it is possible that the operating cycle is longer. Here again, what does it mean? What are we talking about when we say an operating cycle? Well, an operating cycle is when I first buy my goods, and I owe money for that, right, to my suppliers. Then I turn around and sell the goods, and then eventually I will collect my money. I can pay off my suppliers and buy goods all over again. So it is a cycle. We buy goods, sell goods, collect the money, pay off our suppliers, and start buying goods all over again. So usually that's, like 30 or 60 days for an operating cycle to take place for most retailers. So what kind of business would have an operating cycle longer than a year? Well, typically that's somebody who's constructing, something that they're selling. And what would take longer than a year? Well, a very, very large building or a ship, something like that. So the ships or a very, very large building. Okay, so one of the criteria is that it's based on time. And then the other criteria is that it requires the use of current assets to pay it off, or we create other current liabilities. So either we use current assets like cash, accounts receivable or inventory, right? Those are our liquid type assets. Cash obviously is liquid. Accounts receivable will turn into cash. And then inventory, we will sell it and convert that to cash as well. So those, we liquidate those assets. Or it's also, we use those to pay off these short-term liabilities, or we create other current liabilities. So we exchange one short-term payable for another is a possibility. Okay, so that's it. So we know what a liability is. Now, how do we differentiate current from long-term? Because they both require future sacrifices, generally of assets. In the case of a current liability, the sacrifice is current assets. Okay, how do we value liabilities on the balance sheet? Well, generally, those are reported at the present value of those future cash outlays. So you think, in the future, we have cash, year 1, 2, 3, 4, 5, cash payable all the way into the future. And so we take those discount those back to the present, and that is our value. However, in practice, that's not the case for current liabilities. In practice, current liabilities are usually just reported at the maturity value because that's just easy to do. And the practicality is for a short-term liability, that's only due like within days or a few weeks, the maturity value just isn't going to be that much different than the present value. So the difference is usually immaterial. That word in there as well. So the difference between maturity value and present value for those current liabilities is just immaterial. Okay, and then on number 4 and 5, I just asked, the difference between accrued liability and a deferred? Accrued liabilities are really just due to unpaid expenses. So we've purchased something, or we've incurred an expense like salaries or utilities, and we just haven't paid for it yet. So examples again are salaries, interest, property taxes, income taxes, payroll, bonuses. All of those create accrued liabilities. So then what is a deferred liability? Well, a deferred liability really usually is centered around when revenue is recognized. So that's when we receive the cash first and we owe goods and services. So examples of that would be like airline ticket sales, right? If we're the airline, we sell the ticket first and we owe the service. And so we'll earn the revenue when we fly somebody from one city to another. Magazine subscription sales would be another one. The sale takes place first, we get our cash, and then we deliver the goods later and earn the revenue. Gift card sales by a retailer would be another good example. We sell the gift card, but we don't actually earn the revenue until the customer comes in and exchanges that for some goods, and then we earn the revenue. Okay, so let's take a look at exercise 1, and it wants us to look at these items and determine, how are we going to report these things on the balance sheet. So I'm actually going to, most of these, if you go through, are going to be current liabilities. I'm only going to talk about the exceptions to that. So, if you have any questions about the ones I don't address, be sure to just ask your instructor. Number C, service warranties on appliances can be current liability or it can be long-term. Long-term, is the same as saying a non-current. So the warranties can be, we may warrant something for our product for, a few months or several years. And that would make the difference with current or long-term. G, deposit received from customer. Again, that deposit could be for performance in the short run, or it could be long-term over several years. Discount on notes payable. Again, it depends whether the note is a short-term note or a long-term note. Oops, sorry about that. Let's just do long-term there. Also want to point out, remember the discount is a contra liability. We'll see that in the next. If you don't recall that, we'll go over that here on the next exercise. So it's a negative liability. So it does get reported in with the liabilities, but it's a contra liability. Number L, personal injury claim pending. This kind of depends, but if we assume it's not probable, then we just are going to disclose this in the notes. So it'll really be a note disclosure, and it will not go on the balance sheet itself. So again, something like that where it's not probable that we're going to end up losing this claim, we'll just disclose it in the notes. And we'll get into those in a later exercise as well. Current maturities, by the way, this is a current liability. Don't know why I went over that. Cash dividends declared but unpaid. Dividends and arrears on preferred stock. Those are not liabilities. And again, that would be a note disclosure. Let's talk about that a little bit. Because if we have a cash dividend, that actually is going to be a current liability. But dividends and arrears on preferred stock. So if we have preferred stock, let's say $100,000 par for preferred stock, and it has an 8% dividend rate, well, that's an $8,000 dividend annually. And if we assume this is cumulative, that it has the characteristic that it's cumulative preferred stock, well then, when we do declare dividends, we have to pay that $8,000, and it accumulates year after year. Well, why isn't that a liability then? Well, it's not a liability because we don't legally have to pay these accumulated dividends unless the board declares a dividend. So it's not a liability until it is declared by the board of directors. So that's why it only gets disclosed. Loans from officers can also be short-term. Of course, we can also have a loan that's long-term. Okay, exercise 2, quite frankly, I would encourage you to just sort of stop the recording right now and go ahead and make these journal entries. I went ahead and worked ahead myself on them. So if you want to stop, pause, and make sure that you could work these out. Okay, so assuming that you've read through these by now and working those out, the first one, and by the way, hope you notice it's a periodic inventory system, so we are not going to record purchases in the inventory. So had this been a perpetual inventory system, we would have been debiting inventory here instead. But that's not the case. We do not have a perpetual inventory system, so we have these purchase accounts. So we put the purchase in the purchase account and create accounts payable. Then apparently we didn't have cash in order to pay that, so we're going to exchange the account for a note payable, and it's only a 12-month 8%. On the same day, we're going to borrow $50,000, so cash will come in of $50,000, but we have a different obligation. It's a 12-month, zero interest-bearing note, and by now I hope you have learned in the course there's no such thing really in substance, in economic substance, there is no such thing as zero interest because time is money. So we know that in the future they're going to have to pay off $54,000. So we're going to put the face of that note in the note payable account. So again, there's no such thing as zero interest, although the contracts may say that, but in substance, there really is interest. Okay, so we can see that there is going to be interest in the future of $4,000. So we're going to debit something for $4,000. Well, do I debit interest expense? Well, we haven't really used the interest yet on the day that we borrow the money. So it's not an expense yet. And that's where this discount on notes payable comes into play. Discount on note payable. I'm just going to abbreviate that. So we have two accounts, note payable, and then we would subtract the discount to get the net liability, right? So those are net to $50,000 would be our net liability. $54,000 payable minus a discount of $4,000 gives us a $50,000 net liability. Okay, we have two notes. This $50,000 one and then this $54,000 one. So let's start with the first one. 3 months will go by, right? October, November, December, and we need to accrue interest expense. So, we're going to debit interest expense. What will be the credit? Well, we won't have paid it, so we'll have interest payable. And then we just do our calculation. $50,000 principal, 8% annually, and 3 out of 12 months have gone by. So 50,000 times 8% times 3/12 is $1,000. Okay, let's jump on down to, well, what would get reported then on the balance sheet for this? Well, for one thing, we would have $50,000 in the note payable. I'm just going to abbreviate that. So we'd have this $50,000 note payable, and we'd also have this $1,000 interest payable, for a total liability related to this note of $51,000. But it would consist of these two accounts. But a combined net liability of $51,000. Okay, let's go to the next liability. Next note that we recorded was the discounted note, the $54,000. So we know the interest cost over the year is going to be $4,000. So interest in the future interest expense is $4,000, but only 3 months have gone by. So that's going to be interest expense of $1,000. What do we credit? Well, this time we're going to take it out of the discount. So discount on note payable. I'm just going to abbreviate that. So let's go down here to the bottom. So what are we going to see? Well, here at the bottom, we're going to see $54,000 in note payable. And then we're also going to subtract out the amount in the discount. How much is there in the discount? Well, we started with $4,000 in the discount. We just credited it to reduce it $1,000. So there is $3,000 in this discount. So those will net to $51,000. And that's a really good illustration of, just a regular interest-bearing note we saw here, and then the discounted note that claims to be zero interest. Okay, moving on, I've added in brief exercise here. Again, I encourage you to pause the video and make the journal entries. Keep in mind it is a periodic inventory system. So if you will, just stop, go ahead and make the journal entries for these, and then we'll work through it all. Okay, now that you've come back, we can see that there was a $60,000 purchase with these terms. So, again, we're debiting purchases instead of inventory, $60,000. Likewise, they paid freight, so we have a freight in account. And again, both of these, if this was a perpetual inventory system, we would have been debiting inventory in both cases for that. Debit inventory for the cost of the goods, but it's not perpetual, so we have these purchase and freight in accounts. Then there was a return of $6,000. So we take it out of accounts payable, and instead of reducing purchases, we indirectly reduce purchases through this purchase return account. Well, let's post our accounts payable. So we have a $60,000 credit in the first transaction, and then the second transaction we had a debit of $6,000. Okay, so after the return, there is a balance of $54,000 in the account. Then we have the third accounting event where we pay for the goods. But keep in mind, they're paying within the 10 days. So they're going to get the discount. So, you've seen this before. I'm just going over it in case you have forgotten. So accounts payable, when this is all said and done, needs to have a zero balance, right? So we're going to debit it $54,000 to zero it out. How much cash will we pay? Well, we get a 2% discount. So we're really not going to pay all of that. We're only going to pay 98% of the amount owed. And so that's going to be $52,920. So our cash payment is going to be less because we get the discount. And the actual discount, the 2%, is $1,080, and that just goes into a purchase discount. And before we finish, just one final comment. If this had been a perpetual inventory system, all costs would go into the inventory, all costs would go out of the inventory, so we would have credited inventory here to reduce it for cost, and the same thing with the purchase discount. That would have reduced our cost of inventory. So inventory would have gone up for the initial cost of what we bought, and it would have gone down for any returns and any reduction of cost. Exercise 3. Exercise 3 is really a refinancing. So there's $1,200,000 of short-term debt. It's due February 2 of the next year. And before this company issues its balance sheet on January 21, they refinanced. They issued 25,000 shares of stock for $950,000. So they sold stock, and they used the proceeds of that sale to help liquidate this short-term debt. So that's really refinancing. Now you can refinance with either, debt or equity. So it could have been that they, refinanced by issuing another note, but in this case they didn't. They refinanced with common stock, and it's in either case these are both can be long-term methods of financing. So here's the question: if I know that this short-term debt is going to be refinanced with something that's long-term, is it really short-term debt? So is it appropriate in the balance sheet dated December 31st? Is it appropriate on this balance sheet to list all of that $1,200,000 as all current liability, even though legally, according to the contract, legally it is short-term? But the question here is in substance. In substance, what's the, or another phrase is, what's the economic reality? What is the economic reality? Because this $1,200,000 is not all going to be paid off in the short run. We know that some of it has been refinanced into long-term financing. So is it current or not? Well, there's a couple of things that have to be met. There has to be intent to refinance. And so the company did have intent to refinance it before it issued its balance sheet. And does it have the ability? Well, the company clearly had the ability because they did refinance into stock or equity, if you will. So both of those criterion have been met. They both had the intent to refinance a short-term debt, and they had the ability. The ability is demonstrated before they issued their balance sheet. Notice they don't really release the balance sheet until February 23. So in between December 31st and February 23, they met these two criteria. So because of that, the $950,000 is going to be long-term. So we're going to report of the $1,200,000 of current liability, supposedly current liability, $950,000 of that is going to become long-term before the balance sheet is issued, and the other $250,000, that $250,000 came from cash. Remember, a current liability, one of the definitions is that it is liquidated with a current asset. So again, remember, current liabilities require the use of current assets or the creation of other current liabilities. We talked about that earlier in this recording. So it used a current asset, that makes that a current liability. The remainder of it is long-term. And by the way, there would be a note disclosure about this refinancing, just saying, that, there would be a note talking about the refinancing. The $950,000 with the common stock and the $250,000 with cash. And again, you would write a nice note. I'm just putting comments here, but it would be written, in a sentence format. But it would be, this $1,200,000 of short-term debt was financed before the balance sheet was released with $950,000 of common stock, and then paid off with $250,000 of cash. Okay, let's look down here. I've got another similar case. Let's go over it. Okay, on brief exercise 4, we have a $500,000 note payable due, within a month and a half after the end of the current year. So if Burr refinances the obligation, so again, refinancing, there was, are two key words here. There has to be intent and ability. So if Burr refinances the obligation by issuing a long-term note, February 14, right, that's before the release of the balance sheet, and uses the proceeds to pay off the note, how much of the $500,000 should be reported as a current liability? None of it. The whole $500,000 will be considered long-term debt. So it'll go under long-term liability because they had both the intent to refinance and the ability. I mean, they've already demonstrated the ability because they did it. Okay? Let's look at the next one, though. Here's another scenario. So again, if they pay off the note on February 15, so what if they pay off the note on February 15, assuming they use their cash, okay? So they use their cash to pay it off. Then they borrow $1 million on a long-term basis. How much of the $500,000 should be recorded as a current asset? Well, here's the question. Did they have intent to refinance? No, it really doesn't look like they did. Look, on February 15, they paid it off, and then, a couple weeks later, they have another borrowing. These do not appear to be connected, as if it does not look like they intentionally borrowed the $1 million to pay off the $500,000 note. So because of that full $500,000 will all be a current liability. Again, they lacked the intent to refinance. They did not meet that criteria. So it's all going to be a current liability. Okay, so we've gone over several concepts about liabilities. We'll stop with this recording, and I'll have more for you for Chapter 13.